Hey guys, and welcome back to our channel. In today's video, we'll be discussing some of the common 401k mistakes that many people make and how you can avoid them. Retirement can be scary if you have financial issues. You can avoid such an experience by saving cash in a 401k plan. This is a savings plan that most employers often sponsor. The plan can help you achieve financial independence. It's easier to make use of a matching 401k plan that your employer offers than to create your own account somewhere else and start investing. When you choose the 401k plan sponsored by your employer, you can fund the account using some of the cash from your paycheck. You should start using the 401k plan early enough during your career so that you can do more when you retire. Note that simply participating in this savings plan does not necessarily guarantee a successful future. Here's an example that can help you understand this. A certain 25-year-old employer that started regularly contributing to their 401k account would have accumulated more than $350,000 by the time they turned 60. Things, however, did not go well since the 60-year-old had only $100,000 saved in their 401k account. You may be wondering what went wrong. Though 401k is popular, some savers make a lot of mistakes that make it hard for their nest egg to grow. You have to make smart decisions regarding when to start saving, how much you need to contribute, and how to manage the 401k plan account. To help you out, we came up with a list of common 401k mistakes that many savers make and how you can avoid them. Let's get right into them. Missing out on the company match. If you work in a company that offers a 401k savings plan, there's a chance that it also offers its employees a 401k match. The employee match contribution is like free money, since it is the bonus that you can get from the company for contributing to the retirement account. This comes in the form of a certain percentage. Ensure that you join the 401k plan sooner than later, so that you don't end up losing out on these matching contributions. Contribute up to the employer match to ensure that you get all the money that the company owes you. Since the employer match forms part of your overall compensation, missing out on it means you're not getting enough of what your employer should pay you. The employer match can significantly increase your retirement savings. Let's say, for instance, a company offers a 50% match, up to an amount that is 6% of your income. If, for instance, you earn $40,000 a year, the employer can put in $2,400 a year. To get this, you have to ensure that you contribute at least $400 every month to the 401k savings account. You should also avoid leaving the company job before you're vested. Some companies require 4 or 5 years of service before an employee can qualify for the full 401k match. Dipping into the account when changing jobs. This is also another common 401k mistake that some people make when changing jobs. Some dip into the 401k account to pay an unexpected expense or debt when short of cash. Doing this is not advisable due to the penalties and heavy taxation. Since this can have a negative impact on your retirement savings, you should open an emergency savings account while still working to help with such expenses. You can either transfer the funds to an individual retirement account or your new employer's 401k account. Doing this can prevent you from spending cash on other things. The process of transferring the funds to another 401k account or an individual retirement account is referred to as a 401k rollover. The process of completing a 401k rollover is easy. If you decide to transfer the money from your old 401k account to a new IRA account, you have to do this within 60 days. Get in touch with your former employer and complete the required forms. Once you do this, the former employer should send a wire or check for your account balance to the new account provider. The account provider will then give you details regarding how the wire or check will be made out. You can either opt for a direct or indirect 401k rollover. Also, try to stay in one job for a long time rather than changing jobs from time to time to avoid going through such processes that may have an impact on your 401k plan. Making minimal contributions. The problem with some savers is that they make very minimal contributions towards the retirement plan. Some even fail to contribute on a regular basis. This can prevent you from saving enough for your retirement. The average contribution percentage for employees saving in a 401k plan is 6%. The amount that you should save varies depending on your personal goals. Though predicting the amount of money that you may need to live a comfortable life during retirement is not easy, you should have some retirement savings goals in mind. This can help you assess how much you need to set aside to achieve financial freedom. Consider running a retirement calculator at least each year. You can calculate how much income your annual savings and current retirement account are likely to generate at retirement. So, how much should you be saving? Financial experts recommend saving between 10 and 20% of what you earn. If you get a raise, you should increase your 401k contribution. Ensure that your cost of living remains the same, even when you get a raise. Though saving more can seem frustrating at the moment, contributing more to the 401k plan can make your retirement better. Make it a habit and avoid missing years of contributions. Cashing out. Do not make the mistake of cashing out your 401k plan before you turn at least 55 or 59 years old. Some people cash out their 401k plans to make large purchases, such as buying a car or land. Doing this before this age can trigger a 10% withdrawal penalty. You will also owe an income tax on the distribution. For instance, if you withdraw $5,000 early, you'll be subjected to an early withdrawal penalty as well as an income tax of about $1,200. Apart from that, cashing out before you retire can also make you miss out on compound interest. The more you leave your funds in the account, the more they grow. Rather than cashing out the 401k plan, look for other alternatives to fund your purchase. If you don't have any other alternative option, you can consider taking a loan from your savings plan. Though this is not the best option, it is better than making an early withdrawal. If you choose this option, ensure that you repay the loan within the required period so that the IRS does not consider it an early withdrawal. If you lack the finances to pay the loan, the IRS can include it as a taxable distribution. Failure to pay the tax can force the IRS to deduct it from the remaining balance in your 401k savings account. Lack of understanding the drawbacks of 401k. Before you enroll in a 401k savings plan, you should understand that this plan has both advantages and disadvantages. Weighing both sides of the coin can help you determine whether it's the best choice for you. For instance, the 401k plan has a few investment options that you can pick from. The investment options are often limited to mutual funds and ETFs. You should also be aware of the fees associated with a 401k plan. People who work for small companies sometimes have to pay more fees than those who work with large companies. You should never ignore the fees and other expenses associated with 401k. According to the U.S. Department of Labor, 401k fees include individual service fees, investment fees, and administration fees. These fees can gradually reduce your savings, leading to less retirement money by the time you're ready to cash out. Before you join the savings plan, you should take your time to review the documents so that you can find out how much you will be paying in relation to fees. If you fail to plan properly, one of the biggest expenses that you may have to deal with is taxes during retirement. 401k plan gives savers less control over taxes. We also mentioned that you cannot always withdraw money from the account whenever you want. Once you understand all the downfalls of a 401k plan, you can decide whether it is better than its alternatives for you to make a more informed decision. If you've not yet started saving for retirement but have a job, you should consider enrolling for the 401k plan soon. Doing this can prevent you from having lots of financial worries when you retire and no longer having a monthly income. Understanding the 401k mistakes that you should avoid can help you grow your wealth and enjoy your retirement years. That's it for today's video, guys. Do you already have a 401k account? What is your experience so far? Have you noticed some mistakes that you've been making and would like to correct them? Let us know in the comments section below. Don't forget to hit the like button if you enjoyed the video and subscribe to our channel for more financial videos.